Everybody, Brian Shannon here from alphatrends.net. Today's Friday, May 9th, 2014. Let's look at the closing numbers for the week here. The S&P 500 was basically unchanged. The NASDAQ lost a little bit, and the Russell 2000 continues to be the underperformer. Now it's got a year-to-date loss of 4.6% and below its 200-day moving average. We saw the strength come in to the commercial real estate. The IYR was up 1.2% this week and 12% year-to-date. So let's take a look at the charts here and see if we can make some sense of this, because a lot of people are confused, and rightfully so, with the S&P 500 within a percent or two of all-time highs, and it is continues to hold above the 20 and 50-day moving average and this prior support. So when we look at the S&P 500, we see what appears to be a healthy market that's correcting more through time than through price. And next week we're going to want to see that 186 and a quarter to 186 and a half up to really 187. This is our near-term band of support that we want to see hold. If that can continue to hold up, perhaps this market can continue to move higher. Year to date, we see the volume weighted average price is down at 184, and that's been a big level, of course, as far as support goes. We broke briefly below it about 3 weeks ago, but recovered quickly, and here we are again close to all-time highs. So as long as we remain above probably 186 and a quarter to 187, somewhere in there, then we want to give the benefit of the doubt to the buyers, but recognize that the S&P 500 is really more neutral here than anything. The NASDAQ is a little more ominous, I guess, is what I was about to say. We do have this level that's been acting as resistance at 88 to 88 and a quarter, and we're going to need to see the NASDAQ get back above there to have any confidence that the buyers can regain control of this market for more than just a day or two. We do have that declining 50-day moving average in that area as well, which adds to the significance of the level and takes away from the likelihood of the bounce in there. The longer term, we're sitting on the 150-day moving average, but a test of the 200-day moving average would bring us down to about $84, and that's something that if the NASDAQ does break down below this past week's lows, then I think a test of that 200-day moving average is something that would look reasonable. If we look at the year-to-date volume weighted average price, that's the purple line in there. The other line is the 5-day moving average, but the purple is the one we want to look at on this chart. You can see that we've been having trouble with that volume weighted average price near about 87.50. So really 87.50 up to 88 and a quarter, that's the important level that's going to be more difficult to get through. If it can get back above there and hold above there, then I would expect that maybe we see some shorts get squeezed. Otherwise, we have to be very cautious with this market, especially in the light of the fact that we do have a declining 5-day moving average. Now, we've seen a lot of volatility. We saw this sharp sell-off and then a sharp rally, another sell-off. So we're seeing, again, a lot of volatility here, and we don't know if this market is being accumulated or if this is distribution before a bigger decline. But with the declining 5-day moving average and this band of selling pressure that's been in this market just above, we have to be very careful. There's been a lot of disasters in the NASDAQ names as well. We'll look at some of those towards the end, but let's just continue looking at the major indices. The Russell 2000, as I said, we're closing below the 200-day moving average, and we've been kind of dancing on this area of support that we had seen. That was last year's little resistance here for a while in the fourth quarter of last year that turned into support here in January of this year. And the fact is, we are in a downtrend in the NASDAQ. We've got a declining 10, 20, and 50-day moving average, and we've got a pattern when we look especially at this 30 or the 65-minute chart. We've got a clear pattern of lower highs and lower lows and a downward trend line. I think for us to have any confidence that something can last a little bit longer as far as a bounce goes, then this is going to be the key level up near about 112 and a half, and that's pretty far away. Of course, we've got this level from this week at about 111 and a quarter. That was prior support and then resistance. So the thing is, the downtrend, it's not turning back up with any ease at all. It's still guilty till proven innocent, and you really have to be careful about buying into a market that's declining because we simply don't know where the support will be found. This has been an important level, so maybe we test that 107 and a quarter to 108, but even there we don't know if this is the beginning of a bigger, more severe decline as we've broken that longer-term uptrend on the weekly chart in the Russell 2000. It simply doesn't make sense to be getting long in here. The semiconductors have been really kind of neutral here the last week or so. The bigger level of importance is down here between 43.5 to 44, and that's where we've seen this market find support numerous times this year. Otherwise, it's just kind of neutral in here. Looking at the year-to-date volume-weighted average price, we can see that it's right here at $43.85. So that kind of further strengthens the importance of this area. If we're to break below this level, then perhaps we see a deeper decline. But for now, we have to just be very cautious with the semiconductors. Let's go back to the Russell for a moment, too. I wanted to point out that we'd been finding resistance at the declining volume-weighted average price year-to-date, and currently that's 114.19 in the Russell 2000. So that'll be an important level to kind of keep an eye on as well. The financials for the week, what were they? For the week, the financials lost a little bit of ground here. But on this daily time frame, you can see we're just kind of in the middle of nowhere here. We've got this really what's been an important level between really 21.95 up to 22.20. We're below a 50-day moving average, so looking at a 30-minute time frame, we're just seeing a lot of back and forth action here with the high end of this recent band up near about that 22.20 level, and 21.50-ish as far to 21.60 has been the band of support. But we've been just kind of going back and forth in between there for a couple weeks now, so there's really no advantage trend-wise to being involved in the financials right now. I would kind of say that I'm a little bit cautious on them. If you look at some of the action in the individual names like Citigroup, like Goldman Sachs, like Bank of America, and those names, they definitely give us reason for caution overall in the financials. Looking at Apple, it was down 245 for the day, and it lost some ground this week. So it did get below the 5-day moving average, and that 5-day moving average acted as resistance. We're seeing a little bit further pullback. The volume-weighted average price since the event was taken out. That's at about 586. I don't see that as a big deal. I think that this pullback is healthy in Apple, and maybe we continue to drift down just below into maybe 575. But for now, I think that initiating new positions in Apple doesn't make sense, not while we're below a declining 5-day moving average for longs. And with the bigger picture in an uptrend, then any shorts you want to do should be for a very short-term time frame. Disaster of the week, maybe for most people, was Twitter. Twitter's been in a confirmed downtrend for a while. It took out the lows on that gap and went down just under $30 a share. It's bouncing a little bit, but it's still in a downtrend. It's still guilty till proven innocent. If they don't scare you out on the way down, they'll typically wear you out. You can get some nice bounces in these downtrend stocks, and it's no different than a chart I posted on StockTwits today, which is MCP. If you remember a couple years ago that MCP and the rare earth names were all the rage. People were raising their targets and their guidance over and over again and talking about how China was restricting their exports, and that was going to keep the price for these rare earths high, metals high, and that so many applications were going to keep the demand strong as well. Well, again, I've been talking about this one for a while, saying that, and I've seen a lot of people get excited about the bounces over and over again, but we keep bouncing to lower levels, and we're still seeing lower highs and lower lows, and this week MCP continue to get crushed here. There's just no bottom in sight for this. If they don't scare you out on the way down, it will typically take a while for them to rebuild a base of support and a new level of group of owners who can take it higher. So when you're looking at stocks like Triple D, which has a great story like MCP did, it's in a downtrend. It's been in a downtrend for a while. I'm not saying it can't bounce or it might not turn around, but the odds certainly don't favor that a bounce in this area will sustain itself, not with a declining 50-day moving average, a declining 100 and a 200-day moving average. These stocks, again, they're in trouble and they need time to heal. So we saw a lot of of damage. It wasn't just Twitter, of course. We saw Tesla get hit. That came down, and I think you're going to need to see this one kind of consolidate for a while down in this area. I don't, the momentum is still lower. We had a little bounce in it today, up $3, but the 200-day moving average just below. Perhaps we can kind of settle down in this area. Year to date, the volume weighted average price for Tesla is up near about 205, and if we look at, we can take a look at a Fibonacci retracement off the lows from the fourth quarter of last year, where if we were to get a 61.8% retracement, that would get us down to about 173. So I think 173-ish is realistic for this market next for Tesla next week. So be careful with that one if you're looking to be a buyer. On a daily time frame, perhaps for intraday scalps, that's fine. But realistically, we've got lower highs and lower lows, and the sellers are in control, just as they remained in control with FireEye. And FireEye, people have been trying to buy the bounces in here, and then they just got smashed again. Same would go for Fuel and Financial Engine. You look at ISRG is a mess. There's been some real damage to some big name companies too, and a lot of people are saying, well, shouldn't that bring the S&P 500 down? How come the S&P 500 isn't going lower? Because these stocks aren't in the S&P 500, and if you're going to trade the S&P 500, you don't trade the S&P 500 based on what the Russell 2000 is doing. You trade the S&P based on what the S&P is doing. You trade the Russell based on what the Russell is doing. You trade gold based on what gold is doing, not what the dollar is doing or what these theoretical relationships are supposed to be. You trade each stock and manage risk on its own individual merits. Once you start trying to add more complex pieces of the puzzle and become this global type manager where things should interrelate and connect, they disconnect quite often, and it will leave you with losses trying to explain why the market is wrong and why it should be this way or that way, and trying to justify your losses. But the fact is, tech stocks are in trouble. The shares of Google continue to try to find support near this 200-day moving average. If you want to succeed in the market, you need to have a strategy that's applicable in any environment. What I talk about each and every day at Alpha Trends is trend alignment and looking for the low risk, high probability trades. That's what we're focused in day in and day out, mainly for swing trades. We do a lot of day trading as well. If you enjoy this end of day video, for $149 for a year, you can get this video every day that I produce them. And you can look at the silver and gold membership levels as well, which have a chat room and swing trade ideas, day trade ideas. So I hope you guys are doing okay in this market, because there's been a lot of destruction. Look at Whole Foods this week. Look at Zulily this week. Look at Pandora continues down. Big names, NetSuite continuing lower. Don't be the people that buy these things on the way down, because you can get hurt very badly.